Hello and welcome to My Finance Teacher. In this video, yet again, I want to broadcast a little bit of a warning on the general stock market, which I think is getting somewhat stretched within the ongoing intermediate cycle, especially looking at the duration of the intermediate cycle, and perhaps a bit more alarmingly, over the last couple of weeks or so, we see some developments in S&P 500 as well as other indices, of course, that are showing that a possibility of an intermediate cycle correction down into, say, closer to the 200-day moving average is quite likely, perhaps over the next several weeks. So let's look at the details. This ongoing intermediate cycle, as I've just mentioned, is already quite a bit stretched. It's 224 days long, with an average of around half a year or so, perhaps a little bit more than that. Still, this intermediate cycle is already unusually long. Of course, we have seen such intermediate cycles even in our relatively recent history, going back to the pandemic lows. Over the last 5 to 6 years, we have actually seen intermediate cycles that lasted for even longer than that. The longest after the pandemic lasted for 228 days over here in the middle of 2023. Is that in middle of 2023? That's mostly throughout of the 2023 over here. That's 228 days. Currently, though, we're already at 224 days. So unless the correction takes only a couple of days, this cycle is already going to be the longest, at least since those pandemic lows. Now, looking at some of the technicals, zooming in at the cycle, especially at the last couple of daily cycles, some of the technicals I want to point out here is firstly this negative divergence on RSI. That's a situation when price creates higher high with RSI creating lower highs. Usually negative divergence precedes a bit of a correction down into those intermediate cycle lows. And zooming in even more at the current daily cycle, especially over the last couple of weeks, we've actually seen a lower high not only on RSI but also on the price. So price is now starting to confirm perhaps that negative divergence on RSI. And this week, the most interesting question for this week is whether we are going to see a lower low as well. If that happens, that would be yet another signal that the stock market is starting to correct down into that intermediate cycle low. And those corrections can be pretty scary. Anywhere from 10 to 20% correction is a common occurrence within those intermediate cycle corrections. I've already mentioned this 200-day moving average. So next I want to have a look at slightly more details in relation to that 200-day moving average. The lower section of the chart over here is the distance of S&P 500 from that 200-day moving average in percentage terms. So again, going back to pre-pandemic highs, looking at the history of 6 to 7 years over here, we see that often these intermediate cycles top where S&P 500 is stretched anywhere from 10 to 15% above this 200-day moving average. Yes, there were intermediate cycles that didn't even reach that high, as in, let's say, these hard times of 2022. But generally speaking, once we reach anywhere above 10% stretch above the 200-day moving average, that usually suggests a bit of a caution going into the future. And zooming in within this ongoing intermediate cycle at the all-time highs back a couple of weeks ago, S&P was actually around 11.4% above the 200-day moving average. So yes, it can go even further. The highest we've seen was close to 15.4% above the 200-day moving average, but that was a very strong bounce out of that pandemic low. So while it's possible that S&P just continues to chug along higher into an even more stretched intermediate cycle, but the signs are already there that caution is advised into the next several weeks. And lastly, let's look at market sentiment. It's very important to look at market sentiment as you want to be somewhat cautious when everybody is elated, and you want to be greedy, as they say, when everybody is throwing in the towel. We see that market sentiment, the optics index on S&P 500, is also showing a negative divergence over the last several weeks, and over the last few days it already dropped sharply from above 60 to below 50. Again, the big warning sign that the traders have started bolting for the door, and we haven't even seen any crowd casualties yet. So once this decline has actually started, you really want to be careful until this optimism index comes much closer to this green zone, perhaps somewhere into the 30s, maybe even below that, as in, let's say, this April tariff scare. So to sum up, the cycle as well as the S&P over its 200-day, both are somewhat stretched, kind of like my pants after an all-you-can-eat buffet. And well, you know what happens after something gets too stretched. So be careful out there, have a terrific Tuesday, bye bye.